Hey guys. Um, so a good place to start, I think, is if we just want to go around the speakers and do, a quick 2 minute overview of yourself, what you're working on. So why don't we, Connor, start with you?
Good morning, gentlemen. Connor Donahue. I'm the Vice President of Investments at Caliber Companies. We are a vertically integrated real estate investment firm headquartered in Scottsdale, Arizona. Here today, just discussing our Opportunity Zone offering. Was launched late 2018, has 5 projects across Phoenix and Tucson right now, and will likely be expanding into the Bryan College Station area in early 2022. Kind of a blend of different assets across multifamily, medical office, and hospitality. I think as the fund matures, we'll hone in a little bit more on medical office and multifamily specifically. Raised about $130 million to date over the last 3 years. Our plan is to close this offering June 30th, 2022, and launch the second iteration of it. And that's pending some legislation that I discussed with Ashley yesterday, and looking forward to hearing him speak on as well.
Great. Daniel?
I'm Daniel Ocean. I'm the Chief Strategy Officer of ShopOff and Integris. We are a 30-year-old real estate company, works nationally on added value and opportunistic real estate. Integris is focused on our direct consumer platform. Within what we do, we mostly focus on development, entitlement, and repositioning of commercial real estate. We have a single QOZ product. We are not a QOZ sponsor. We've never been kind of that pigeonholed in what we do. We are focused on long-term value creation. In this case, we found an asset that we thought was particularly special, and it happened to be in a QOZ. It's what's going to be called the Dream Hotel and Casino in Las Vegas, or the Dream Las Vegas product. Dream is a national or international brand of lifestyle, entertainment, hospitality. They have an incredible footprint and process. This is on the Las Vegas Strip. It is an extraordinary piece of real estate. It's catty-corner to Mandalay Bay, less than a mile from Allegiant Stadium. We're raising $173 million in equity for a $500 million plus development that will break ground in Q2 of 2022. We have our entitlements and FAA approval in place, and we're just moving forward towards getting ready to actually break ground. But we are in an extraordinarily unique location with a very unique product with some incredible prospects for long-term outcome we're pretty excited about. So that's what we're working on. In addition, I play a pretty big role in the industry talking about both QOZs and real estate securities in general, and have a long history of doing that, both as an association president with the DISA and in other factors in areas with different organizations.
Excellent. Thank you. Ashley?
Ashley Tyson. I'm an attorney, real estate developer, and business consultant. And I'm co-founder of ozpros.com, along with Jimmy Atkinson, who's the host of the Opportunity Zones podcast. And we are a full service agency of kind of catering to folks that are more the do-it-yourselfers, the ones that want to have bespoke opportunity funds and opportunity zone businesses, and to either place their money into their own deals that they're developing, whether that's real estate or business, or they're looking to kind of do a hybrid investment into lots of different operating entities that are QOZBs. So we started out as kind of the legal Zoom, and when people who are kind of trucking through the documents and still trying to figure out the structuring of those, we kind of shifted into more of a full service agency where we do strategy calls. We still do the organizations, and then we also help with ongoing compliance and having conversations with people around that type of stuff. So excited about talking with you today. We've had over 600 strategy calls, and we've set up over 750 opportunity zone entities. So we've talked to a lot of people around the country, and we're fairly well through Jimmy and through the podcast are plugged in with a lot of the kind of the thought leaders inside of the opportunity zone space. So looking forward to hearing what we're talking about today.
Great. And just quick intro on myself. I'm Nate Wiggum. My firm is Ian Capital. We do all types of commercial real estate capital advisory, all property types, all parts of the capital stack, all of the country. Spent most of my career in Southern California, but about 2.5 years ago, I moved to Puerto Rico, which is where I operate from now, which is a whole another interesting discussion, especially around op zones. We're also a member of a consortium of boutique brokers with offices here, LA, Miami, and Atlanta. So great. So this is a pretty dynamic time for opportunity zones. And I think maybe a good place to start the whole conversation is, Ashley, can you just give a very quick rundown on, what's the kind of current change in structure that will occur at the end of this year with regards to the step up in basis on the deferred capital gain?
Yeah, absolutely. So, the drafters of the legislation were nothing short of geniuses that in 3 pages, they were able to, number one, get the attention of private capital. Number two, to get them to be willing to invest for 10 years. But then number 3, to get them off the sidelines. And the way they did that was with these capricious deadlines they baked into the legislation. So the first one was that you get a 15% step up in basis if you've invested for 7 years prior to when the Tax Cut and Jobs Act program times out. So accordingly, you had to invest by December 31st, 2019, in order to be eligible for holding for 7 years prior to that date. The second deadline was that you get a 10% step up in basis if you're invested for 5 years prior to that date. So effectively, if you're invested into an opportunity fund by December 31st of this year, you can get a further 10% reduction in your taxes when you go to pay them in 2027. So that goes away on January 1st. Now, that's absent an extension, but the good thing is that neither the IRS nor the legislature has indicated that there's going to be an extension or anything like that. So accordingly, I think that it serves its purpose, which it creates an incentive for folks to get their money into the game, before the end of this year, which is beneficial for the folks that are doing developments in opportunity zones and ultimately for the opportunity zones themselves.
Got it. So what are you hearing, or what is kind of the word on the street with regards to any potential changes coming down the pipe or an extension? Is there any conversation around that?
Yeah, so we actually talked about this a little bit, in a call that I was on yesterday, that there's all types of legislation that keeps getting introduced, but it's been kind of single partisan, right? So the Democrats are introducing stuff, the Republicans will introduce things, right, about extensions and that kind of thing. And I don't think that any of those have a shot at getting through where they actually get passed, absent them becoming bipartisan. And so the bipartisan efforts that will probably ultimately come to fruition are probably not going to happen until after the midterms. And so, when that happens, I think that there's probably going to be significant enough time between now and then to maybe and ultimately end up getting some of the wish list into it, which is that, that the conversation now is an extension of trying to get 4 years as opposed to 2. The word on the street has been that it'll be extended for 2 years, or that's likely to happen. I think that the bipartisan effort is going to try to push for 4, and maybe it gets pushed back to 2. Maybe it gets extended out even more than that. I think that the good thing is that all of the legislators have seen that this actually is getting the attention of private capital, and so it's going to give those folks great fodder for being able to say, hey, this program actually works. So let's extend it out and let's give it, the opportunity to really kind of push forward. Now, inside of that, and there is going to be a give, I think a potential give. And one of the asks on that give is that some of the non-low income census tracts get eliminated and that they effectively get phased out for going forward. And so I think that that's probably something that's likely going to happen. And then, I think that a layup that everybody can count on is that there's going to be increased impact reporting requirements, so that there's an actual structure associated with how you calculate and you report the impact that you're having in the opportunity zone that you're doing that you're actually doing development in.
Ashley, I'm curious because I've heard that brought up a number of times, but I've not heard in my work with government any kind of consensus of what that actually might look like, and how you can take the million different variables that each of us, some of these are businesses, some are development, they're in this place, they're in that place. How do you put together any kind of system that would be of any value? I mean, I'm sure they can ask, how many jobs do you think you created? And people could write that on a piece of paper, but how do you see this actually having any real likelihood of coming to a culmination of use? Even if you ask me, and I don't know about Connor, but you could ask me to define on our side what impact we have, and you could put Connor in our project, and he might have a completely different perspective, even if he worked for us, of the same answers, because a lot of them are subjective. They're not easily defined. The impact on tax, or the impact on long-term job creation, things that haven't occurred yet, or that you don't have control over, data to extract. How do you see that coming forward?
Yeah, I think that it's going to be tough, right? And I think that there probably is going to be deficient, right? Because that's the only way they really can. Because to your point, a lot of this is subjective, and a lot of it is, significantly downstream impact that is, just associated with economic development as a whole. And I work with a PhD here in Charlotte who does impact analysis for banks, for the big banks, on their CRA programs and on different things like that. And there's so many different factors that go into it that it would be impossible to come up with a framework that wouldn't completely overwhelm people that aren't, massive multi-million-dollar funds. And so doing this in a way that's going to be manageable for, the folks that are self-reporting on this thing, I think it's going to require that it be fairly minimal relative to what the impact is going to be, probably into the tune of like the jobs created and that kind of stuff that's actually fairly ascertainable, right? If you've got direct jobs that are being created and that kind of drill. I think it's going to be really tough to come up with a framework that's going to be able to apply to all of these, namely because you got such a wide variety of businesses. How do you do that on any kind of, fairly easy form that you could fill out that you could submit to the IRS? I think that that's going to be the biggest challenge of the whole thing. So to your point, Daniel, I think it's probably going to come back to fairly limited, information.
Well, and the other thing you mentioned that I thought was interesting is the potential changes. I think it's a very positive thing that there's such bipartisan support for opportunity zones. I think that bodes well for the typical question I get, which is, do you see them, going away? Is there a chance that they'll be removed or whatever? I don't think that that's likely. But you mentioned that there's going to be maybe a shift to focus on lower income. The issue I have with that is there's a perception somehow that this was intended to be something to benefit low income. And I don't know that actually was the part of the structure to begin with, but even if there was a shift to it, my experience has been in opportunity zones, and most of them are not being developed in what would be considered low income areas. And just by taking away the higher income areas that they're theoretically looking to remove, all they would do is just cut back the amount of opportunity zone work that would be done. It's not like we would suddenly shift to saying, well, gee, we found this great asset that actually made economic sense, but we're going to get rid of that and do some deal that didn't make economic sense in the low income area just because there was a hope that somehow people would do that. And I don't know that that's a very smart process for them to pursue. So I don't know how likely that is to ultimately get completed. It would be unfortunate because I think it would really limit opportunity zone projects if they focus them purely on areas where the deal itself has to make economic sense, but might not in those environments based on the amount of revenue that you could generate from development.
Yeah, I think that, unfortunately, right. I mean, it's like it's anytime you're talking about dealing with a governmental program, you got to deal with the stuff that the the metrics that you can actually measure. And so they had to come up with a way in the first place, right? And so they said, okay, it's going to either be low income census tracts or census tracts that are adjacent to low income census tracts, because they're trying to get investment into the underinvested areas. And so I think that even if you were to eliminate the ones that aren't low income tracts, that there's still going to be attractive lower income census tracts that are out there that are candidates for doing opportunity zone deals. And you still have some good deals in those areas. I think that what their goal was is to kind of try to remove the ones that are happening, you know, in the boroughs of Manhattan and maybe Brooklyn and some of the other areas like that, that are getting a lot of the, you know, a significant portion of the opportunity zone investment, to try and spread that wealth around a little bit, which is, I think, what ultimately was kind of the goal of the program. But to your point, even if it is in areas that aren't those, you know, that they still need to make economic sense. So, I mean, unfortunately, I don't think that there is a silver bullet on here, but I think that the good news is that it seems like on this one area that there's a willingness for both parties to kind of come together and try to figure something out. And so maybe this could be a shining moment of bipartisan, you know, actual collaboration here. So I'm waving my magic wand here, right? That you know, we could actually utilize this in order to get people together.
Let's hope.
Yeah.
That'd be a welcome change to see that. So Connor, Daniel, I mean, you guys are actively, you know, just recently raising or currently raising now for an option deal. So I'm just kind of curious how, and we're kind of continuing the same thread of the conversation with regards to the change at the end of this year. How have you, or just have you not seen that adjustment in the year? You know, really, has that created a sense of urgency from the investors that you're talking to? Were you able to get capital to come in kind of quicker than it might not have otherwise, given that constraint?
It's absolutely accelerated our capital raise on our end. I think for smaller dollar investors, it's really more of a psychological thing. Really, when you do the math, it's actually a quite small benefit. When you're talking higher net worth people, it definitely makes a big difference. So there's definitely an urge to get in between now and the end of the year because of that, and also because of, you know, these limited partners have 180 days from when their gain was triggered to deploy the money. But a lot of times it's just easier from a filing perspective to place the capital in the same year that the gain was triggered. If you extend that across, you know, a gain triggered in 20 that's invested in 21, it can get a little stickier from a filing perspective. That's not really a problem on our end. It's more for them and their filing. I did want to go back to the impact reporting, and I thought Daniel made a really good point on the subjectiveness of that. I was looking at our Q3 report today, and somehow one of our multifamily deals, student housing, ground up in Tempe, Arizona, here at Arizona State, ranked higher on the impact report than a behavioral health medical facility that is, you know, providing jobs and a really good service to the community, and something that's, you know, really come to light over the last almost 24 months here. And somehow on the meter, the student housing ranked higher on the impact report. So it does seem rather subjective to me as well. And I did want to see if Ashley could touch on briefly a hypothetical, you know, 2-year extension to 2028 to both take in capital and for the LPs to pay their tax. Would you see that also retroacting the 15% back to the end of 21 and then extending the 10% to 2023? I
think you almost have to, right? If you do that, because you know, you've got all these folks that are scrambling to get their cash in by 2021. And that would be the way that you could, you know, get the folks the benefit of, you know, that were in by 2019, also by 2021. It gives them effectively that same benefit.
Actually, Daniel, what have you seen on your end?
The same. What Connor's saying is entirely true. There's, you know, there's a hockey stick happening right now. We're raising more money per week now than we probably raised certainly per month previously. You know, I mean, the influx is heavy. Where I do see What you said, Connor, is true. The 10% benefit is, in my mind, is meager compared to the value of the lack of recapture on depreciation and the value of not paying tax on your gain. Of course, that's all subject to somebody actually making you money. But the where we are seeing kind of an interesting increase as a result of the 10% is particularly people with broken 1031 exchanges, where they had an exchange they weren't able to make, and this has an even bigger impact for them, and it kind of pushes them over the edge. Or people who have stocks where a lot of them are like Silicon Valley guys who have stock options and things where basically 100% of whatever they have is gain. And so a 10% step up on, to Connor's point, on a pure dollar amount basis is much more meaningful to them. You know, if you have a very small capital gain, it percentage-wise, it's all the same for everybody, right? But the impact becomes meaningful at a larger dollar amount. So we're seeing a large number of people talking about $1 million, $5 million, $10 million capital gains, some much more. I mean, we've had conversations with $25 and $50 million capital gains people. And obviously at those levels, any amount of money is a lot of money. At the $100,000 investor level, I don't know that it quite has the same impact. But we are definitely seeing a big ramp up, and also seeing a lot of confusion of people who don't understand how the process works, and a lot of misinformation. I can't believe how much bad information is out there, how many CPAs know nothing about QOZs, read a little bit, and then opine to their clients wrongly. One of the things I hear regularly is, as long as you've committed to subscribe by 12/31, even if
You're good.
You haven't put your money in by 12/31, you're still okay. Or worse, this is my favorite one, is you can make your investment now and sell your stock in 2022. It's like, you can't backwards exchange into this. You have to have all your money and information in on time. And there's certain things that are just, there's so much misunderstanding. They don't understand the lack of, or how the tax process works or any of that. It's dangerous. So I'd say for anybody listening, you need great tax advice to make sure you don't misstep, because a misstep can blow the whole purpose of doing this.
So that's a good segue into one of the questions that we had, which is, how does recapture get handled? What's the risk around that? You want to speak to that?
I'll start. I think the recapture issue is the absolute best part of the QOZ. The upside, I mean, it is great. You don't pay tax on that, and depending on how much upside you have over a 10-year period, that's a big amount of tax. But there are similar, somewhat benefits in any kind of real estate deal in some way, shape, or form in terms of growth and magnification of growth. But depreciation is completely separate from normal real estate. Whereas if you depreciate at the end of the sale, you have to recapture it. In this case, you don't. And in our deal, where we're looking at north of double-digit cash flow on an annualized basis, and we, based on the kind of depreciation we'll have, think we can cover, I mean, somebody's cash flow, and I assume most QOZs are going to work like this. Most or all of your income should be sheltered, and then you get to not only do you not recapture on it, but you get to take all that money that you now haven't paid tax on and invest it in something else and magnify those gains over time. And I think there's an incredible power in that. And I don't see any circumstance under which that rule will be changed retroactively, unless somebody on this call knows something I don't know.
I think Daniel hit it on the head, and yeah, we're similar boat. We're hoping that any distributions from net operating income are covered by the losses on the K1. I think, generally speaking, it wouldn't make a lot of sense to make too much in distributions from an OZ fund without the depreciation, because you're now triggering an interim tax liability in a fund that investors are investing in to not pay taxes. So I think that's, again, definitely one of the biggest advantages of the fund. And we're in the same boat, where we're hoping that all those losses should negate any income that come from the fund.
Yeah, it's interesting too, right? And I deal with a lot of operating businesses and a lot of businesses that have kind of tangible personal property. and even big ticket tangible personal property items will be eligible for the step up in basis to fair market value, which will mean that and I think that's also kind of the significant thing, is that you don't actually have to hold the asset for 10 years. You've got to hold your interest in the fund for 10 years. And so, for Daniel's single asset funds, that's, they're going to hold it for 10 years and they're going to get the benefits out to their investors and that kind of thing. But for folks that are running businesses, this could also be applicable because they're going to be able to depreciate those individual assets and then be able to sell those after they get to, the 10-year hold at their QOF level and still get the step up in basis to fair market value. So, I've got gentlemen that have RV parks, and they are acquiring, RV assets, which have significant, like these tiny homes, and they have significant depreciation that they're able to take out in bonus depreciation. And then they'll be able to sell those after their fund turns 10 years old and not recapture any of that. So it's significant not only for the big boys, but it's also for the, for the mom and pops as well.
So we got a question in the chat here that actually this is probably a good one for you to answer. So they're saying they have multiple properties and land and op zones. They've closed on them and are working on entitlements, which are close to being complete, but not done yet. And so they want to know if there's a way to still take advantage of the op zone incentives, although they were not initially purchased in an op zone fund.
So there's a couple of things, and I regularly have strategy calls with folks that that have unintentionally set up qualified opportunity zone businesses. So if you created an SPE and it's directly owned, right, and you acquired the dirt, and then you did your entitlements and you're building it out and that kind of thing, you can turn that into a qualified opportunity zone business just by bringing opportunity fund cash into the mix. So by bringing capital gains into a QOF and then dropping it down into the QOZB, we can take that entity that you used as an SPE and we can convert it into a QOZB. If it's not in an SPE, a lot of times we can take the assets that are not opportunity zone assets and we can pull them out and we can make it so that it is basically an SPE that we can then convert into a QOZB that way. If we can't do either one of those, one of the kind of the last, I guess, elements of that is that you could sell it to another fund. And as long as you sell it to them prior to them getting their certificate, or you getting the certificate of occupancy or putting it in service, right? So advertising it for lease, that kind of thing. Another qualified opportunity zone business / qualified opportunity fund could take advantage of the fact that you've newly constructed this building right before you actually put it in service. So there's a couple of options that we regularly walk people through, but I'd say that the ideal one is that you created an unintentional QOZB.
So Daniel, let's chat a little bit about your project specifically. I think there's a lot of things that make it really interesting, but do you want to just give everyone kind of the quick rundown in general of the project, and I have some specific questions around it.
Sure, I'd be happy to. So as I mentioned, it's a 526 key hotel. It's catty corner to Mandalay Bay on the Las Vegas Strip. It's the closest new hotel to Allegiant Stadium that'll have more than 200 events a year. It's having the Super Bowl in 24, I think. They're talking about opening a baseball or soccer on the Tropicana property just up the street. We're across the street from the golf course, catty corner to the Mandalay Convention Center, which is, I think, the 5th largest in the world. And we happen to abut private aviation, which is really cool at the airport because high rollers and wealthy people can come in there. But Jet Suite X, which flies, it's a regional, kind of a Southwest that uses the charter method, parks right behind us. You can be out of your plane and in our hotel in under 5 minutes. We're also the closest hotel to Southern California, really, in terms of luxury hotels to drive into the Strip. So everything new is kind of happening on the south end of the Strip. Dream is our brand. They're our operator. Dream is a spectacular chain. If you've never gotten to know them, they have their food and beverage entertainment revenue is off the charts in pretty much all their hotels worldwide. They did pretty well even during the pandemic. This will be their worldwide headquarters or they're premium property worldwide. And we have a casino, which a lot of people ask about. How do you do that in QOZ? We do that through what's called a condominium process, which essentially just says the property is bifurcated into two parts, one of which will be a lease to a third party operator, which is how you get it to function within the QOZ structure. We also are doing this on the land lease intentionally. There's a variety of reasons, but the primary benefits are we get full depreciation and you don't have the carry cost. Las Vegas land is very expensive, as you might imagine, and especially on the Strip. And this way we can have full depreciation rather than partial depreciation and not have the carry cost, which improves IRR pretty significantly over the holding period. We have something called the Founders Club, which is, I think, super unique in that, we do a lot of development. You can come visit my apartment buildings or industrial properties and drive by and look at them, and they're pretty boring. But this one, you get treated as an owner. You get to actually get picked up at the airport, get VIP treatment, front of the line access, upgrades, room credits, custom labeled alcohol. On the higher levels you go up, you get access to our Allegiant Stadium and Golden Knights boxes, or even can do co-branding opportunities or custom designed suites, all kinds of things in the hotel. So it really is kind of a unique environment where you can participate and enjoy your ownership in addition to just being an investor.
So you mentioned Jet Suite X, so I'll second that. I used to fly Jet Suite X from Southern California to Northern California when I was living there. It's fantastic, and the thought of going from LA to Vegas, that is great. It's a security check's basically a high five. You just high five and get on the plane and go. It's great. So just to be clear, so you said that the reason you could do the casino is based in an op zone is effectively because it's leased to a third party operator. Is that right?
That's correct. So
would that apply to every other, kind of sin business, whatever you want to call it, that was excluded from the legislation?
I can't answer that specifically because I think it depends on the sin. But and I'm not an expert on. Despite what you might see here, I'm not an expert on all sins, just many. But in this case, Baker Tilly is our tax advisors, and them in conjunction with Seyfarth Shaw, which does our legal. This is a structure they came up with. It apparently was not unique, and we're not the first ones to think of it. I don't want to, we didn't create the wheel, but it works very well in that if you can isolate the sin from the ownership, then I believe there's a pathway. Now, I can't again tell you that that's every sin. For instance, we own the underlying land. You can't sell land to yourself in a QOZ. So because the land is owned in one entity and the construction is being done and development and ownership is going to be in another, we could not sell to ourselves even if we wanted to. There's no amount of condo process leasing that fixes that problem directly. So indirectly leasing, doing a land lease, fixes that problem. So it isn't the condominium structure that fixed it, but it was the lease structure, as you mentioned, that allows that to function within a QOZ and give all those benefits. And I don't want to. I know poor Connor's sitting there. The guy hasn't got to talk about his project yet. I don't want to take up all the time, but I do think that it is that kind of creativity that becomes very important in developing a QOZ, is understanding all the rules and then being able to work with them, as opposed to I see a lot of them that seem to make significant missteps and having the wrong kind of advice.
Nate, I think that it's the condominium piece that allows them to do that because they're effectively going to own it. And I would imagine that they're probably spinning out that piece relative to the actual casino floor into maybe a separate company that's non-opportunity zone or something along those lines relative to that condo piece. And then if that's the case, then that's one of the ways that you can skin that cat.
Is that how you have?
I don't.
So basically, like that condo section that is leased to the casino is held in a separate entity that's different from the ops entity.
That's one of the ways that it could work. Correct.
Got it.
And I don't know if that's how Daniel's done it or not. I haven't seen his docs or any of his stuff, but I'm, just on the condo basis alone, that could be a method to be able to accomplish it.
There's a variety of ways to structure it. It is an interesting thing to look at. The main thing is that the ownership of the casino, the management of the casino can have nothing to do with the ownership of the KOZ. And as a third party lease, that is the catalyst. But the condo, as you mentioned, actually is doing it in a condo structure is what facilitates that opportunity.
Makes sense. So we got another question in the chat here. You're talking about land. So the question is, you own land since 2013. Can you create an OZ fund and have the OZ fund lease the land for 50 years to develop the building as an OG project if it's the same ownership, the same principles between the development entity and the landowner?
I'd have to unpack that and come up with an answer, but you can own the land from whenever you want. You can then lease it as long as it's a separate entity, and the land lease would allow you, as I understand it, to build on it and qualify for a KOZ. I think there probably are questions to be asked to verify that, but it seems like
yeah, that's one of the ways to skin the cat, is it on a related party deal, because when you own the property previously, you can't convey it to yourself and thus get past that 2017 deadline. And so a related party lease is and a ground lease is a way that you can get around that. It has to be at arm's length. It's got to be on, commercially reasonable terms, and there can't be prepayments of it. And if there's an option, it's got to be at fair market value. So there's some nuances to it, but you could use a ground lease in order to skin that cat.
So effectively, you can take advantage of opportunity zone treatment for your building improvements on properties you've held, going back, it sounds like indefinitely, as long as you structure it appropriately and check all the right boxes.
Correct. So the ground lease can be a way that you can effectively deal with a bad asset. And, and then one of the ways that, we've seen folks deal with stuff as well is by utilizing a ground lease while they're kind of doing the improvements to it. And then once those improvements get past a certain threshold to where the property can be sucked in as a bad asset, that then they buy the property at that point in time. And so, a ground lease with a purchase option on it on the back end can be another way. But once again, there's nuances to it that you got to make sure that purchase option is at fair market value.
Right. So Connor, let's chat a little bit about some of the projects that you guys have been able to execute on, in your ops fund.
Yeah, absolutely. So we're a multi-asset fund, so I'm kind of going to I'll breeze through these pretty quickly, and then keep in mind too, Nate, we do, raise a good chunk of our capital from retail, high net worth retail investors. So our funds are on a broker dealer platform. I'm FINRA licensed, so I need to keep it in a public forum. I kind of need to keep it high level. I'm happy to chat with anyone offline as well. The first project was a DoubleTree hotel in Tucson, Arizona, attached to the convention center. It was finished in March of 2021. So we were under development for most of the heart of COVID. It's certainly better to be under development of a hotel than owning an operating hotel during that time. Second project is in Tempe, Arizona, 42 unit multifamily student housing, walking distance from Mill Avenue for anyone who's familiar with Arizona State University. 2 and 3 bedrooms. We're operating it as like a full apartment complex, although we can sell them off one by one when we decide to liquidate. We're doing a kind of a downtown transformation in Mesa, Arizona. 8 kind of historic buildings we bought on Main Street, right off the light rail. For those familiar with the Southeast Valley, it's kind of neighboring towns, Chandler and Gilbert, have kind of walkable downtowns with shops and restaurants. And Mesa's the 3rd biggest city in Arizona. It's a little bit behind the times. We have the advantage of, again, the kind of the only public trans in the valley. The light rail runs right through Main Street where these buildings all are. We have a lease signed by Launchpad at one of the properties. I know there's LOIs, I think, on all of them at this point. Various breweries. There won't be any kind of chains, restaurants, or anything like that. Furthermore, Arizona State's moving like, it's one of the biggest undergrads, I think, in the country, next to the University of Minnesota. Something like close to 50,000 undergrad. And I think they're moving 15 to 20,000 students over to their Mesa campus. Behavioral health and medical facility I touched on earlier, that's in downtown Phoenix, down the street from Banner Health. It's an old senior living facility, 96 bed, and it's run right around a 90% occupancy since we opened it in September of last year. Basically for folks who are, in the ER, but need certain psychiatric treatment as well. It's a good business model. It's almost completely funded by government entitlement programs. And that doctor group we're working with out of there, they've done a handful across Indianapolis and a few in Texas. We'd maybe like to expand with them into Boise or Reno, perhaps, markets that are kind of on our radar. The final deal is a small deal, is only about $5 million deal, is a charter school we built. It's categorized as light industrial if the building were to be repurposed. It's a school that we're basically just expanding their K through 12 campus. We're going to build the high school campus just next to it. That's in Scottsdale, just a mile or so from our office. And then on the horizon, we have about a 900,000 square foot medical campus that's even closer to our office. You might ask, how does medical office in Scottsdale get into an opportunity zone? The answer is it's on tribal land. So all tribal land is opportunity zone eligible. And then
clarify that. So all tribal land nationwide is option eligible?
As far as I know, yeah. Ashley, I don't know if is there?
I'm not sure that they said that they designated all tribal land. I think that they, and I don't know that every single one got designated. It might have been eligible, but I'm not sure that every single reservation that's out there is thus an opportunity zone. I think it might have been eligible, and then in Arizona, they actually designated it as, but I don't necessarily know that all tribal land is an opportunity zone.
Okay.
But I do know that there are zones in Scottsdale based upon the fact that it is tribal land. Correct. Yeah.
So everything in the East Valley, east of the 101 is all tribal land, as well as if you get south of Phoenix on the way to Tucson. I know those are both opportunity zone eligible. And then real quick, we're doing like a sidecar deal with a bank out of Dallas, and they're looking for they don't have capital gains issues. They're just looking for Community Reinvestment Act credits, which has a significant amount of overlap with opportunity zones. So all that means for any investors in our fund is we should have a couple deals in the Bryan College Station is the area we're looking at right now, which certainly a tertiary market. I'm not overly familiar with it. We do have a lot of clients in Texas though that are pretty bullish on that area. It's about, if you flew into George Bush, it's maybe less than an hour and a half from North Houston there.
So that's interesting. You just mentioned that some banks have CRA dollars. Can any of you speak to that a little more depth? Does CRA money from banks qualify as option capital?
No, we would create a fund for them, and then our fund would invest alongside them. With regards to the deals, I think there tends to be a lot of overlap between OZs and CRAs. So that's the plan, is to find.
Got it. So it's different capital receiving different treatment, but investing in complementary deals, basically.
Correct. We're at the final stages with the attorneys on that one. I know there's been a lot of back and forth about commingling and exactly what we can and can't do there. And so we're buttoning that up right now. Hopefully have it funded, at least the equity portion, before year end.
They did open the door for banks to make investments, and so for them to be able to make capital gains investments into opportunity zone deals. And so in theory, I guess this would be the question as to whether the banks are actually doing this or not. But in theory, a bank that has substantial capital gains could roll into an opportunity zone project and then also utilize that investment as part of their CRA credit. So I don't know that there's, and I'm not, Connor, it doesn't sound like they're doing that in your case, but I think that could be a possibility.
Interesting.
I mean, that's very interesting. I wonder how many banks would even be aware of that. You know, banks that have the CRA credits. That might be an interesting pathway to capital for opposite sponsors.
Yep. And as well is that there's also new market tax credits overlay too. That's a potential here, because most opportunity zones are also eligible for new market tax credit. And so, folks should be pursuing that, with their CDFIs, with their local CDFIs, and with their lending organizations to tap all available funding resources, whether that's, new market tax credits money or CRA money, or just investments that the bank might potentially make and be interested in making.
Yeah, it's one of the great things about op zones that you can stack them with all these other potential incentives. I mean, Ashley, I know you're working on some stuff here in Puerto Rico, and 98% of the island here is an opportunity zone, and there's so many tax incentives and a lot of historic properties. Like if you're doing something in Old San Juan, you get opposite treatment, you get historic tax credits, you get Act 74, hospitality related tax credits, among other things. So it's definitely, there's other things you can tie into op zone deals. Yeah, so Connor, I'm just kind of curious, and Daniel, this is a question for you as well. On the retail side for op zone investors, is there like an investor profile that's more common than others? I.e., is it mostly, I don't know, doctors that are investing, or is it, tech guys that you sold a company or are selling a bunch of stock? Is it a lot of crypto investors? Like, is there something you're seeing more than others?
I thought when we first launched the fund, it would be a lot of people selling real estate, and it's been any kind of capital gain you could think of, stock, crypto, real estate, business sales. I've definitely gotten a lot of traction from tech in the Bay Area. Just, I think simply because you have younger accredited investors who that 10-year timeline for them, they can absolutely stomach that. I think, when you're talking to, someone in their mid 30s who's made 8 figures in a sale in Silicon Valley, they're a lot more, generally gung-ho to invest in something like this, as compared to, someone in their mid 60s who had their wealth tied up in a small business forever and is now finally liquid. So it's been all across the board. We definitely have had a lot of traction from Silicon Valley, though.
I would say the same. I think the saddest part of all this is there's so poor education and such a poor lack of understanding amongst financial advisors, CPAs, lawyers, and the actual investors, that very few people actually know about it. So I don't have a statistic for that, but just from direct involvement in the universe, I think I would be surprised if 2 or 1% of people with capital gains even knew, with enough money to bother, even know that this exists. I would say 1 in 5 CPAs knows anything about QOZs more than that they exist. It is an area under which there's so little knowledge that people are missing the opportunity. And I don't know if there was universal knowledge about it, if it was known like 1031 exchanges, where all the money would come from. But to Connor's point, there's kind of there's a spattering of people on the internet who've done research and figured it out on their own. There's people coming in through financial advisors who are gold mining for them because they figured out that this really is a benefit for their clients, and therefore trying to help their clients utilize it to their benefit to sell stocks or their businesses or whatever. And there are some CPAs and lawyers, but unless you find somebody with knowledge, it's just lost on them. I have a CPA I know well who keeps throwing people at me. He still doesn't know anything about it. I've spent hours trying to explain it. But he doesn't. He doesn't want to take the time. It isn't worth his time. It's just not that important to him. So he's just kind of letting it slide. And if I want to talk to his clients, I can. And we've raised millions of dollars that way through one CPA who just He's like, look, if the client asks, I'll send them your way. It's a sad thing to see that it's not as well communicated and understood as it could be prior to this 10% step up disappearing, because it's going to go away, and it'd be good for people to have that opportunity. Because you only have a 6-month window to invest, anybody who misses that window is on to the next thing. And I can't tell you how many phone calls I get from people saying, well, is there some way around the 6 months? That is probably the single most common question I get, is what could we do if we missed it?
Private letter ruling.
Yeah, I just tell them no. Yeah, the answer is no. It is what it is. So Connor, I agree with what Connor said.
Yeah, it's funny that you mentioned that, and I think that that's one of the reasons why it. I think that we've seen of all of the programs that have been done where the federal government's tried to tap private money and align private money into something that they want to see happen. I think that this one has gotten substantially more interest than any of the previous ones, namely because they made it and they tried to make it as easy as possible. But to Daniel's point, the problem is that there was a tight time frame. And so, when I was originally talking to broker dealers about this, they're like, it doesn't make sense for us to learn it, because it's going to be, by the time we put together all of the educational product and the packaging, and we get it by compliance and do all that kind of stuff, it's going to time out. And so it's like, we're going to make all this investment in it, and then we're not going to get a return on our investment because the program is going to be gone, which is one of the reasons why, we got to be talking to our legislators about, hey, dude, let's extend this program, because this thing's good, right? This thing is, it's actually, and granted, there's deficiencies in it, but I think that it's the first program of its kind that's actually moved the needle on, being able to drive capital and have conversations with people and be a tipping point, for local communities and that kind of thing, to get their act together and to actually try to get in front of private capital and to draw investment. So
guys, we've got about 5 minutes left, and we have a few more questions from the audience that I want to make sure we get an answer to before we wrap it up. So I'm going to just kind of run through them really quickly, and whichever of you would like to answer, please go ahead and jump in. First question was, how can an opportunity zone invest in industrial assets with triple net leases?
it can't.
Good short answer.
Yeah, you can't do triple net leases because they're not considered a trade or business by the IRS. So if you're going to do, or you have to do kind of a gross deal or something that's not a triple net. And we've worked around that in different situations, but you can't do a triple net lease.
So to be clear, you cannot buy and improve an industrial property and then go lease it on a triple net basis and receive offset treatment.
That's correct. You actually have to have some kind of actual activity in addition to the triple net lease.
Got it. Okay, next question is, the question is, once you have entitlements completed and you have a permit in hand, assuming it's already an op zone property, should you create a separate QOZB to actually hire the general contractor and run your project money through that entity, or should you just use the original op zone fund that holds the real estate?
So I think that most of these questions, I'm probably going to be the guy to answer these. You would actually want to run it through, you'd want to buy the land in the QOZB and then get the entitlements done in the QOZB, and then have the QOZB engage the contractor to actually do the improvements, because you want it all counting towards your substantial improvement, and you don't want to have to convey the land down the road.
Got it. Next question is the 6-month rule for everyone or just LPs?
Oh, I'll start. Ashley will finish, so I can. If somebody else can speak first.
Exactly. I was hoping you were going to jump in there.
So the 6 months is from when you book a gain. So if you're doing it on an individual basis, if you sell a stock, it's 6 months from when you've sold that stock and you've booked your gain. If you are a limited partner, if you're an investor in an entity, or you are an entity itself, it is from when. It depends on the direct circumstance, but for instance, If you're part of a partnership where the partnership sells an asset, it's not 6 months from when that asset is sold, it's 6 months from when your gain is booked. And Ashley, I'll let you get into more detail here, but there are a variety of circumstances and how it's defined about actually when you book your gain in something where it's not direct is dependent. So something could be 6 months earlier and you might not get your K1, and until you get your K1, that's when your notice occurs, at least as far as I understand it.
Yeah, it's so for any gain that comes through a Schedule K1, to Daniel's point, that 180 days, you can either have it start when the sale happened, or you can elect to have the 180 days start on March 15th when the partnership filing is due. And so if you incur the gain through a partnership or an S corporation to which that gain comes through on a K1, then you have until September 11th of the following year to actually put that into a qualified opportunity fund. And then once your money goes into the fund, the 10-year clock starts from when you put your money into the fund, right? And the 10 years is according to your investment, not the aggregate life of the fund. So you could start the fund in 2018, you put your money in 2021. It's all about when you put your money in, not when the fund was started.
And that's a highly misunderstood thing. A lot of opportunity zones talk about that they're going to be a 10-year hold on the fund, and that isn't true. Like you said, for us, we tell people it's going to be 10 years at least from the day the last investor comes in.
Right.
They have to have a 10-year clock, and there could be people in a year or 2 years earlier, and they'll be longer. You also don't have, this is another thing that's misunderstood. You don't have to sell after 10 years. There is no requirement. There's no gun that says you have to sell 10 years. You can sell 11 years, 12 years, 15 years. I think you have, actually, it's a 25. Is that the number?
December 31st, 2047.
That's why we talked to Ashley. He has all the numbers in his head. So you can hold on to this for a lot longer and get the benefits for a longer period of time if that's the strategy of the fund.
Are they thinking of scrapping that date as well, Ashley, in any kind of potential legislation, and
I think
keep
it's
the program ongoing?
I think that it's going to get extended out, right? So if they extend out the program and extend out that date as well, I mean, one of the things that we're trying to have occur inside of that is to get rid of that date completely and to make it permanent, so that way people can hold indefinitely. So you don't actually have to, exercise by a certain date, which I think would be kind of, that would probably be more closely in line with what they're trying to accomplish by keeping money in these zones. The way that it works right now is that when you actually do make the step up in basis to fair market value, when you make that election, you actually have to pull the cash out of the deal within 90 days. Otherwise, it's considered a non-qualifying reinvestment, which is really kind of a counterintuitive thing, right? It's like, well, if we're trying to bring money into these things, why do you then have to take it out, right, in order to get the tax benefit? And so I think that hopefully they'll fix that in the next round of legislation that happens.
Well, guys, we've got more questions, but unfortunately, we're out of time here. Anyone who's watching and wants to reach out to any of us, I think you can ping the the organizers in the chat, and they'll shoot you over our contact info. Everybody, thank you. I think this is a great discussion. We could have done this for another hour, so there's more questions we certainly could have answered. So I appreciate it.
Thanks, guys.
Thanks, everybody.